Two very popular topics here in the financial community are debt and investing. What I find is that most creators keep these topics separate. Either they're focused on investing or they're focused on getting out of debt or sharing their debt free journey. I feel that a person, unless they're in some horrible amount of debt, if they have the average debt that most Americans have, can do both at the same time. They can both invest while paying off their debt. And that's what I want to share with you guys today. For those of you who are new to the channel, I am Marie Brown. This is my channel, Minds in Motion, where we talk about personal finances, investing, and how to become the best version of yourself. Let's jump into the topic. Since a majority of my videos are on investing, that's where we'll start. Investing is just you using your money to make money. Some easy ways that people earn money from investing their money is through interest, also dividends, as well as asset appreciation, also earned profits, and just through growth. Now, just recently, I made a video on growth stocks, and if you guys haven't checked it out yet, I will leave a card above so that you guys can check out that video at some point, but it will explain to you a little bit more about growth stocks and how to put your money to work so that it grows. Now, a couple other ways that we can invest our money so that it's able to grow is with returns. And how we invest our money to get returns is through stocks, bonds, ETFs, as well as mutual funds and even CDs, which I'm sure a lot of you are familiar with. There are a few things that you may want to consider when investing. One is definitely age. Another is your current income, as well as your time horizon till you retire, and also future tax situations. Again, if you guys are interested in those topics, I have tons of videos on my channel where I review those types of things. So feel free to check out other videos that I posted here, as well as go ahead and take the opportunity to like and also subscribe to the channel. I'm sure that most of you watching this video understands that debt is just the act of borrowing money. Most people's debt come from student loans, buying a home or a car, medical expenses, or unforeseen emergencies. Some of the most common debt and some of the worst debt that most people have is consumer debt from credit cards. And the good thing about student loans is that student loans and home loans usually have some type of tax benefits. The consumer debt that most Americans have don't, and that's the worst debt that anyone can carry. Now let's talk about debt. For many of you who are on a debt-free journey, or you're just concerned or considering how you're going to become debt-free, you've probably heard of Dave Ramsey. And Dave Ramsey has something called the 7 baby steps. And on this 7 baby step journey, he mainly focuses on viewers or followers becoming debt free. So the reason that I wanted to talk about this is because I feel like it has a lot to do with why a lot of people who are on a debt free journey do not consider investing, why they are eliminating debt. So just to go over the baby steps real briefly that apply to this video is baby step number 1 is that you have $1,000 in an emergency fund. Again, I've made videos on that. You can find that on my channel, but it's important to have at least $1,000 in an emergency fund so that you don't find yourself getting back in debt in case an emergency happens. Number 2 is you're going to pay off debt, but that does not include your mortgage. Often mortgages have a lower interest rate, So it really doesn't make sense to pay off a mortgage before you pay off something such as consumer debt that has a very high interest rate a lot of the times. And then step number three is to build your emergency fund to 3 to 6 months of expenses. So once you've paid off all your debt, not including your mortgage, you're going to go back to your emergency fund and you're going to build it up for 3 to 6 months. Now, I don't disagree with that step, but what I want to incorporate today is how you can also invest while paying off debt. And then step number four, that's when Dave Ramsey suggests that his users should start investing. Now, again, depending on your age, depending on your income, depending on how long you have to retire, once you pay off all your debt, build your emergency fund, these things could take a while depending on the person. And it may be too late by then to start investing if you want to get a true return and build the true financial independence that you desire. So that's why I want to show you today how you can incorporate both. Another thing is that interest on debt is usually a lot higher than interest on investments. That's another thing that you want to keep in mind when you're considering paying off your debt as well as investing. There are two types of interest that people in debt have to pay. One is simple interest, which is interest just on the principal, the money borrowed. And then there is compound interest, not to be confused with the compound interest that we talk about when we talk about investing. Compound interest in relationship to debt is when a person in debt has to pay interest on both the money borrowed as well as interest on the interest. So just imagine how much that debt is going up on a daily basis when the company is charging you compound interest. So now, how do we bring both investing and paying off debt together? Advisors recommend that a monthly debt to income ratio, or the DIT, should be no more than 25 to 33% of your pre-tax income. This means that the most that anyone should spend on paying off their debt is anywhere from 25 to 35% of their income. So what we have to do is, of course, we have to learn to live off less than we make. And how we do that, how we cut back so that we have more money to invest and more money to pay off debt, is to, one, cut back on spending, two, eat out less, get rid of expenses that are not necessary, such as cable or subscriptions and things that you may not even utilize anymore, but you're still paying for. Also, create a budget and stick to it. And if you guys haven't seen my budget video yet, I will leave a card above. It's an excellent video. Budgeting is an excellent way to give yourself a raise and have more money to pay off debt while investing. And then also, don't fall back into your bad spending habits. It's so important that once you get yourself in a position where you're paying off your debt and also investing a percentage of your money, do not fall back into the habits that got you in the situation that you just got yourself out of. You have your emergency fund, you have your cash cushion. Now, all you have to do is stay consistent, keep your goals in front of you, make sure that you're budgeting and living off less than you make, and just keep putting your money to work. I am Marie Brown. This is my channel, Minds in Motion. Make sure that you subscribe, you hit the bell notification, and also leave a comment below because it does help with the YouTube algorithm. Thank you so much, and guys, have an amazing day.